Welcome to OLevels Business Studies Unit 26 Analysis of Accounts. Company accounts or financial statements provide data, but analysing figures is essential to draw conclusions. Account analysis interprets financial data to assess profitability and financial strength. Without analysis, determining whether a company is improving or outperforming competitors is challenging. Relying on a single financial figure does not provide an accurate picture. A combination of figures offers a comprehensive understanding. Profitability measures how much a business earns after deducting costs. Unlike profit, it provides a relative measurement by considering sales value or capital invested. Expressed as a percentage, profitability indicates efficiency and helps compare performance over time and against competitors. Investors use it to assess potential investments, while managers use it to guide strategic decisions and improve operations. Businesses assess profitability using financial ratios such as return on capital employed, gross profit margin, and net profit margin. ROCE measures how efficiently a business generates profit from invested capital, calculated as net profit divided by capital employed multiplied by 100. A higher ROCE indicates better capital utilization. Gross profit margin evaluates the revenue proportion exceeding the cost of goods sold, calculated as gross profit divided by revenue, multiplied by 100. It shows production efficiency before other operating costs. Net profit margin, or profit margin, measures the revenue proportion remaining after all expenses, calculated as net profit divided by revenue, multiplied by 100, reflecting overall profitability. Analyzing profitability ratios over time or against industry benchmarks helps businesses identify trends and areas for improvement. A rising gross profit margin may indicate better pricing strategies or lower production costs, while a declining net profit margin may signal rising operational expenses. Changes in return on capital employed reflect shifts in investment efficiency or financial structure. Liquidity is essential for a business to meet short-term financial obligations like supplier payments or loans. Inability to do so leads to illiquidity, potentially resulting in ceased operations and asset liquidation to cover liabilities. Maintaining liquidity ensures smooth operations and prevents financial distress. Two liquidity ratios assess a business's short-term financial health. Current ratio measures the ability to cover short-term liabilities with current assets. A higher ratio indicates better liquidity, but an excessively high ratio may suggest excessive capital in unproductive assets. Acid test ratio refines the current ratio by excluding inventories from current assets, offering a clearer view of liquidity by focusing on liquid assets like cash and accounts receivable. A low ratio may indicate cash flow issues and difficulty meeting short-term liabilities without selling inventory. Liquidity ratios alone do not fully reflect financial health. Comparing them over time and against industry benchmarks provides better insights. A declining ratio may indicate financial strain, while an improving ratio suggests greater stability. Understanding the use of financial accounts is crucial for stakeholders. Managers use them to monitor performance, identify weaknesses, and make strategic decisions such as expansion or pricing adjustments. They also compare ratios over time and with competitors to evaluate strategy effectiveness. Shareholders and investors analyze financial accounts to assess profitability and liquidity before investing. They focus on ratios indicating stability and growth potential. Creditors, such as suppliers, evaluate accounts to determine the company's ability to repay debts and decide on extending credit. Banks use financial statements to assess creditworthiness and lending risks. Governments and tax authorities review accounts for tax compliance and economic impact. Workers and trade unions examine statements to evaluate job security and wage capacity. Competitors use financial data to benchmark performance and identify industry opportunities or threats. Comparing financial ratios helps businesses understand their market position and make strategic decisions. Financial analysis has limitations. Published accounts offer a limited view and may omit relevant data. Financial ratios rely on historical data and may not predict future performance. Inflation and different accounting methods can affect comparability, leading to potential misinterpretations. Thanks for watching. Make sure to like, share, and subscribe for further content.